Everybody, welcome to the market recap. Halfway through September already, which is hard to believe. Kids are back in school, and also noticed many back in the offices. Many companies mandating back to office work this September after 5 years. For many, working from home the majority of the time, having to go back to the office. So, it'll be interesting to see how that plays out in the long term. Big news this week is interest rates. Both Canada and the US, the Federal Reserve and the Bank of Canada, making interest rate decisions on Wednesday. Many expecting a 25 basis point or a quarter of a percent cut on both sides of the border. So let's just see what that looks like, especially in the US, where it's been a while since interest rates have been cut, almost 9 months now since the last cut. What happens when there's such a big gap between federal interest rate cuts? You can see here going back to 1970, months 5 to 12 months between cuts, what's happened. You can see in the short term, over the next month, over the next 3 months, that relatively volatile, kind of mixed 50 to 60% of the time markets are moving up. So fairly volatile, some short-term dips in those cases. But looking out through 12 months, you can see a 91% percentage higher in the markets overall. The average almost 13% 1 year out from that cut that comes after a big gap. So some good news there to look at. Another note that I'm getting now, markets are within 2% of an all-time high, and Feds are cutting rate. It happens a fair bit. You can see back to 1980, the number of times that has happened, where markets have been close to an all-time high, yet the Fed is cutting interest rates. And similar to the last chart, you can see in the short term, a little bit more mixed, a little bit more volatility. As you can see, only 52% over the next month was the market higher. A little bit better in 3 months, but again, look out 6 months, look out a year. You can see 100% of the time in these cases where rates get cut near all-time highs, markets are positive. And again, you can see the average there of 14%. So of course, the last three still hasn't been a year, and we've seen those cuts, but you can see positivity there in the long term. But as we've been saying recently, look out for some short-term volatility. Here's another note. So markets have been rallying. Of course, we had that dip in the spring, but you can see in the 5-month rally here, over 30% gain. So it doesn't happen very often. You can see the previous, going back to 1950, only 5 times has the markets rallied 30% in 5 months. And you can see that by those green diamonds there, the signal dates. So what happens after that? So you, again, look at the short term. 1 month, just a 60% increase rate. So just 60% of the time are the markets moving higher in 1 month period. But again, look at 6 months, look at 12 months. You can see 100% of the time the markets have moved higher. 12-month return, that averages 18%. 12 months after that 30% rally in 5 months. So another positive outlook, but again, some short-term worries there in all of these charts that we're showing you. But looking out a year, things are looking positive. So we talk about expectations for a cut on Wednesday, both sides of the border. Looking at the US for Fed cuts going forward, you can see that by the end of this year, and again, we're already halfway through September, so expectation is 3 more cuts through the end of this year at the following meetings. Of course, one coming on Wednesday, but 2 more cuts after that, and then 3 more cuts in 2026. So a total of 1.5% in cuts is the expectation over the next, call it 15 months. So we'll see what happens there, but money is going to get cheaper is the idea to help the growth of the economy, as both economies, Canada and the US, are in slow growth, struggling potential recessionary periods. Of course, inflation is high, so that's the worry on the other side. But cuts being dropped on both sides, especially in the US at the moment. Some charts that I found interesting through the last couple of weeks here. So you can see US unemployment, it's ticked up a little bit, but it's still only 4.3%, relatively low on average. But you can see that lighter blue number there, the unemployment for younger people, 20 to 24, is now up to 9.4%. So, and that continues to grow. Of course, a little choppier there with a smaller basket, but you can see 9.4% is a bit worrisome for the younger population entering the workforce. I found that interesting. And last but not least, another interesting chart here. These numbers are so big, it's mind-boggling, but you can see the US public debt outstanding and how much it's grown just over the last 4 years. You can see at the 482 mark there 4 years ago, almost 3 times the size of the debt, and just steadily increasing over the last 4 years. Amazing to think the numbers that are going through. And now a part of this chart was stating that the interest paid on this debt is now more than the US is paying for national defense in a year. And you know that's a big number as well. So amazing to see how much the debt has increased. Of course, interest rates lowering is going to help on the interest side of this debt, but still a massive number that needs to get paid at some point. Amazing to see. So I'll leave that there. We'll have more charts coming out in the next couple of weeks. Any questions or want to book a meeting, you know where to find me. Look forward to connecting. Take care, everybody.